Thank you very much, Charlie Pellet. This is Bloomberg Taking Stock live today from Boston, from the Ad Club in the heart, as everybody keeps saying,
Ha!
of the financial
Very nice,
district.
Mr.
Yeah,
McKee.
we're investigating not only markets but advertising and marketing as a key to the economy. And we're talking now with somebody on the financial side, Kevin Divney, who is Chief Investment Officer of Beaconcrest Management and Capital Management. You've been here 15 years, you say. Walk to work. You love the town.
It's a great town, very livable city, big financial community, obviously. I probably, within our zip code here, probably a couple $1 trillion is managed from where we're sitting right now.
Is there a different attitude? I mean, New York is all about how much money you make in the financial industry and whether or not you have a bigger deal than somebody else. Is the same psychology here, or is it different?
Uh-oh, I have an opinion, but I've never expressed it publicly, but I guess I have to now. When I tell people from outside the finance industry, I say that, New York is kind of like the Congress, and Boston is sort of like the Senate. That you tend to have, it's an asset management town, not so much a trading town. So you tend to have more of the prop traders and that sort of perspective in New York. And here you have firms that have been around 100 years or more, or 50 or 60 years, where, New York is somewhat of a different tone.
So how does that maybe change your perspective on market outlook? I mean, I love to talk to people from all around the country because you do get different perspectives, people who don't obsess on every little thing that the Fed says and does, or doesn't obsess on every little whatever economic piece of statistic or so on.
Actually, on one level, I think it can be dangerous because it can anchor you, because sometimes these perspectives are born off an environment that may be shifting or may be changing. For example, I think a lot of the industry gets a perspective from what happened from 92 or from 82 to 1999. And then you really had to think differently. So there are always new firms trying to do it a different way. And I think at the heart of that question is, and what you're asking, Mike, is it's a horizon. What is your investment horizon? And how do you think about that? When things are operating as they should, you can have a very long investment horizon. But I think now we've seen the last 5, 6 years, maybe people would argue last 12 years, there's times when your horizon has to shrink. You need to be agile and adaptive. And that, you love to have it the other way, where long-term fundamentals win, but sometimes it's just not the reality of the capital markets.
Where are we now?
I think we're transitioning to that longer-term place. We're not there yet. I think there's two big obstacles out there. What's happening with the Fed exit or not exit or lack of an exit, whatever that's going to be, and some of the global impacts. But you're seeing characteristics of what's driving stock returns being more stock fundamental, stock specifics transitioning for the last 2 years. That's certainly signs of encouragement versus the risk-on, risk-off environment that we had from 2010 to 2012.
Well, what do you see happening with the Fed exit, non-exit, whatever, whatever your call is, and how should investors think about that?
There's three possible outcomes, one of which the market's pricing in. I think they're going to exit and get back to this great moderation of, fine-tuning Fed policy and having, we had 2 recessions in 20 years. Everybody sort of got used to that. Or we can just stuck in the zero interest rate policy where we end up in a Japan-like scenario. That's low, the market's not pricing that in, or we end up with an inflationary pressures. I think the way they're going to exit and the way they're transmitting that, they stop the buybacks. And they're also going to stop incenting banks to keep more capital on the balance sheet. We start to see that capital slowly go into the economy and not create inflation. If they can manage that, terrific. But again, it's uncharted territory. And if there is another unforeseen shock, it could really panic the markets.
Because they do have this dual mandate, right? And we talk about the unemployment rate.
Maybe not anymore.
Well, and that's what I want to ask you, because, right, in terms of the unemployment rate, we're getting pretty much closer and closer to where they want it to be. In terms of inflation, we're not even close. So what happens?
I think there's an issue is what is the Fed's mandate? The dual mandate of inflation and employment, but now they're still functioning as a lender of last resort. And they have been. The window's still open as it was during the Lehman times, technically, for banks to go to. They flooded the market with liquidity to drive down interest rates to affect what we were discussing earlier, the deployment of capital, the allocation of capital by keeping those interest rates low. And it really, it hasn't had the rapid effect it generally does in a recovery. So I think coming out of this too, the Fed needs to reaffirm to market participants, maybe it comes from Congress, or maybe what is their mandate? Is it just unemployment and inflation? Because they're doing a third thing now, and they're not talking about not doing that again.
Well, has Beaconcrest changed its capital allocation with an eye toward what the Fed is going to be doing in the future?
We don't trade that way. What we have been doing is concentrating our portfolio for the last 2 years, mostly because we're seeing more of stock market prices. We don't look at the bond market every day, is driven more from what we call idiosyncratic or stock-specific returns. So when we look at the post-crisis period, there were elements where stocks were not being driven by the fundamentals. They were not being driven by healthy balance sheets or by prospective earnings. It was, coming in and out of equities. That was a lot of cash flow that was going back and forth. So we find an environment where stock selection, whether it's in the long side or the long short side, is just getting more effective because stocks are being priced based on the company attributes that what the company's achieving.
Go ahead.
Well, you know what I'm thinking? We're talking so much about marketing and branding today here, and I'm just curious, we've done a lot of research on millennials, and in terms of how much money they're going to need to save, a lot more than their parents did, and a lot of them haven't even started. What are you guys doing to go after that sector?
Right now, we're focused on institutions, but I do think there's a sea change in the asset management industry where people need to think differently because they were panicked. People panicked out of putting money into the markets, and now they're afraid to go back in. And what I think the industry needs to do is not just educate people about what their risk tolerances are, which is everybody says that, and that's kind of easy to say, but more, let's understand what your objectives are. And sometimes putting money away and not having to get to it is a good objective for people. But I think what scared people away, especially people that were older during that crisis, is I may need my money sooner. And that's what people have to think about. When do I need it?
All right. So some strategies certainly to think about.
Yes.
All right. Going to leave it there. Kevin, thank you so much.
You're welcome. Thank you.
Great to be talking with you in person. Kevin Divney, he's Chief Investment Officer at Beaconcrest Capital Management, talking to us about the market outlook. You are listening to Taking Stock, and I'm Carol Masser here with my co-host Michael McKee, and you're listening to Bloomberg Radio. We are live at the Ad Club in Boston.